Welcome to Market Brief After Hours. It has been an incredibly volatile day on Wall Street and across global markets. Geopolitical tensions are flaring up once again, completely disrupting the relatively quiet market narrative we've seen over the last few weeks. We saw a massive sell-off in the Dow, oil prices spiking, and a major shakeup in global equities. Let's start with the big picture. What exactly triggered this sudden shift in market sentiment today?
It all comes down to a major escalation of geopolitical risk in the Middle East. During the NATO summit in Turkey, U.S. President Donald Trump declared that the ceasefire with Iran is over. This came alongside news that U.S. forces launched a new round of military strikes against Iran in response to attacks on commercial vessels in the Strait of Hormuz. For weeks, investors had grown somewhat complacent, pricing in a smooth path toward de-escalation. Today was a harsh reminder that a lasting agreement is far from guaranteed, and the markets reacted instantly.
The major U.S. indices certainly felt the impact, though they didn't all move in the same direction. Walk us through those final numbers.
The Dow Jones Industrial Average took the hardest hit, sliding 577 points, or 1.09%, to close at 52,348. The S&P 500 also ended the day in the red, dropping 0.28% to finish at 7,483. However, the Nasdaq Composite managed to buck the trend, actually rising 0.2% to settle at 25,871.
That's a pretty stark contrast between the Dow and the Nasdaq. Why did we see tech holding up while the broader market stumbled?
It really comes down to sector exposure. The Dow is heavily weighted with industrial and consumer-facing stocks, which are highly sensitive to energy costs. When geopolitical tensions spike, oil prices surge. Today, international Brent crude futures jumped 5.43% to settle at $78.19 per barrel, while West Texas Intermediate popped 4.37% to close at $73.52. That massive spike in energy costs immediately hurt consumer giants like Home Depot, which fell 2%, and McDonald's, down more than 1%. Booking Holdings also shed 4%. On the flip side, energy stocks thrived. ConocoPhillips gained 2%, Chevron added 1%, and Marathon Petroleum jumped 5%. Meanwhile, chip stocks stabilized after a rough previous session, with the VanEck Semiconductor ETF rising nearly 2%, which helped keep the Nasdaq afloat.
The ripples from this U.S.-Iran escalation were felt globally. Europe had a particularly rough session today, didn't it?
Absolutely. European stocks closed sharply lower as the exchange of strikes raised serious inflationary concerns for the Eurozone. The Pan-European Stoxx 600 fell 1.61%. Looking at individual countries, the UK's FTSE 100 dropped 1.66%, Germany's DAX lost about 2.3%, and France's CAC tumbled 2.18%. Switzerland's SMI also finished down 1.3%.
I understand Spain's market was under intense pressure as well, and not just because of the oil prices.
That's right. Spain's IBEX 35 fell 2.2%, marking its biggest one-day decline since early May. This was heavily driven by political friction. At the NATO summit, President Trump called Spain a terrible partner and demanded the U.S. cut trade ties over disagreements regarding defense spending and the conflict with Iran. This isn't entirely new. Back in March, there were threats of a full trade embargo after Spain refused to let the U.S. military use its bases for strikes on Iran. But it definitely reignited anxieties today, even though bilateral trade has technically continued as normal.
Meanwhile, France had some economic data released today that paints a slightly more complex picture of their domestic economy.
Yes, the French current account deficit actually narrowed to a seasonally adjusted 100 million euros in May, down from a revised 600 million in April. That's the lowest gap in 4 months, driven by a widening services surplus of 6.4 billion euros. However, their goods account gap widened to 5.5 billion euros, showing that outside of energy, their trade balance swung back into a deficit.
Let's transition to Asia, where the reaction to the conflict flaring up was also quite severe, especially in South Korea. What happened there?
It was a bloodbath for South Korean equities. The KOSPI 100 plunged 5.47%, officially entering bear market territory, as it sits roughly 20% below its record high from mid-June. The sell-off was so intense that the exchange had to briefly halt sell-side trading using a 5-minute sidecar. South Korea's market is heavily concentrated in semiconductors, with Samsung Electronics and SK Hynix making up over 50% of the index. Today, Samsung dropped 6.25%, and SK Hynix fell 5.68%.
It's a clear warning sign that the crowded AI trade is shifting from leadership to liquidation in parts of Asia.
And how did the rest of the region fare?
Japan's Nikkei 225 fell 2.11%, even though their current account surplus widened to nearly 3,968 billion yen in May. In China, the Shanghai Composite fell about 0.5%, while the Shenzhen Component dropped 1.87%. Over in Australia, the S&P ASX 200 slipped 0.21%, and New Zealand's S&P NZX 50 fell 0.71%. Interestingly, New Zealand's central bank raised its official cash rate by 25 basis points to 2.5%, which was in line with expectations to combat inflation.
But Hong Kong managed to be the major outlier in Asia, correct?
Yes, Hong Kong's Hang Seng Index completely bucked the regional trend, jumping 2.99%. Tech giants there led the charge. Alibaba surged 12.21%, Xiaomi gained 9.52%, and Kuaishou Technology rose 8.7%. It was a massive counter-trend rally compared to the rest of the global markets.
Fascinating divergence there. We have a lot more to cover, including the latest on U.S. bond yields, the housing market, and some wild moves in specific stocks. But first, we're going to take a quick break. Stay with us. Welcome back to Market Brief After Hours. Before the break, we were looking at the global equity sell-off, triggered by the escalation in the Middle East. Now, let's look at how this is feeding into the bond market and inflation fears. U.S. Treasury yields saw a significant move today.
They certainly did. The yield on the benchmark 10-year Treasury note, which influences everything from mortgages to credit card debt, rose more than 4 basis points to 4.571%. Shorter-term debt also moved, with the 2-year Treasury yield rising to 4.206%, while the 30-year yield climbed to 5.069%. When oil prices spike like this, it immediately reignites fears of persistent inflation, which means interest rates might have to stay higher for longer.
Speaking of interest rates, the Federal Reserve released the minutes from its June meeting today. Did that give us any clarity on where they are heading?
Honestly, it showed a very divided central bank. This was Chairman Kevin Warsh's first meeting, and the minutes revealed that officials are highly uncertain about how to proceed without more definitive inflation data. Many participants felt the appropriate rate would be at or slightly below the current target by the end of the year, while many others argued it should be above the current range. Because of this division, the market's reaction to the minutes was minimal. Right now, traders are pricing in about a 31% chance of a 25 basis point rate hike at the next meeting in late July.
And how is this interest rate environment impacting everyday consumers? We got some new mortgage data today.
We did. U.S. mortgage application volume fell by 2.2% for the week ending July 3rd. Refinance applications, which are highly sensitive to rate fluctuations, fell 4.1%. Meanwhile, home purchase applications inched down just 0.6%. The 30-year fixed mortgage rate held relatively steady, rising just 1 basis point to 6.58%, despite the broader rise in Treasury yields.
Let's shift our focus to the currency markets. There were some notable movements in Forex today, especially with the euro and the pound.
Yes, the Euro-USD pair managed a slight rebound, closing at 1.1428, up 0.14%. This snapped a heavy selling streak, but the medium-term downtrend remains firmly in place. The pair is trading well below its key moving averages, with the 50-day simple moving average at 1.1572, the 100-day at 1.1611, and the 200-day at 1.1649. Unless buyers can clear immediate resistance at 1.1432, the downward pressure will likely continue. And what about the British pound? GBP/USD had a much stronger session, rallying 0.33% to close at 1.3403. This push has brought the pair directly into a major cluster of moving averages. It closed fractionally above the 200-day SMA at 1.3399 and the 50-day at 1.3401, but is sitting just below the 100-day at 1.3405. If it can break cleanly above this cluster, we could see a sustained recovery, but for now, it's a key technical battleground. It seems the US dollar is still showing immense strength against the Japanese yen, though.
Absolutely. USD JPY extended its uptrend, closing up 0.24% at 162.47. The pair is trading decisively above its moving averages. The 50-day SMA is way down at 159.77, and the 200-day is at 156.90. This reflects incredibly strong bullish momentum, and we are looking at potential continuation toward new highs if it clears the recent peak of 162.71. Meanwhile, the New Zealand dollar also saw a recovery bounce, with NZD/USD closing up 0.51% at 0.5707, though it remains in a primary medium-term downtrend, with its 50-day SMA sitting at 0.5821.
Turning to commodities, how did precious metals handle the market turmoil today?
Gold closed down 0.53% at $4,079. It's currently in a sideways consolidation phase, trying to establish a floor above the $3,950 level, but it is still deeply disconnected from its 50-day SMA of $4,391, reflecting a broader medium-term downtrend. Silver, on the other hand, had a much rougher day, resuming its sharp decline by falling 2.52% to close at $58.36. This unwound most of its recent gains and keeps it well below its 50-day SMA of $70.80.
Let's talk about some individual stock stories making waves today. SpaceX has been in the news lately, following its highly anticipated public debut. How is it performing?
SpaceX stock closed at $148 on Wednesday, which is below its initial trading price of $150 for the second consecutive day. It's a bit of a pullback from its post-debut high of $201.80 back on June 16th. However, it was fast-tracked into the Nasdaq 100 index this week, less than a month after its June 12th debut, thanks to revised exchange rules for newly public companies.
What about the biotech space? Moderna had a tough day.
Yes, Moderna shares shed 7% after Morgan Stanley kept an equal weight rating on the stock. They did raise their price target slightly to $39 from $33, noting that vaccines and individualized neoantigen therapy remain the key drivers, but the market clearly wanted more. We also saw software stocks drag on the market today, with Workday falling over 4% and both Intuit and Atlassian dropping more than 3%.
Finally, there was some major M&A news in the housing sector today that caught a lot of investors by surprise.
That would be Beazer Homes USA. Their stock surged over 12% today after Dreamfinders Homes submitted an all-cash proposal to acquire the company for $32 a share. It's a massive premium and a major bright spot on an otherwise very tense day for the markets.
It certainly was a dramatic day across the board, from geopolitical headlines to shifting interest rate expectations and major corporate moves. That's all for today's episode of Market Brief After Hours. If you find this useful, please follow Market Brief After Hours on your favorite podcast platform.